Hi, welcome to Doc Traders. I just wanted to make a couple of videos explaining some of the myths that are out there in the stock market. You know, average investor's been told buy long, hold through the bear markets. The market works in cycles, and the cycles say that in a bear market you can't afford to hold stocks for long term. And one reason is because they continually go down or they stay stagnant. And as while they stay stagnant, you may lose money on inflation. And we're always getting compared, the stock market today is getting compared to the Great Depression. So I thought I'd show you a look back at the Great Depression, something that your financial advisor or your 401k administrator won't want to show you. Let's say you were buying long term in 1924 and you were continually investing money in your 401k. Eventually, 5 years down the road, 1924, your value's gone up $268. This is the chart of the Dow Jones, by the way. Anyway, the market hits a high of almost $380 for one share of the Dow Jones Index. And what happens? You go through the Great Depression, the crash. Crash starts, you lose, stock values drop to 195. That's about 35% off from the high. Your broker says, hey, stay long, continue to buy. You're not going to retire tomorrow, are you? You got 10 years to go. And you say, yeah, that's great. It's a buying opportunity. At least that was the sales line I was given when your clients call you to ask, what do you do when the stock crashes? Tell them it's buy more. It's a buying opportunity, right? So you do, and a couple months later, the market's back up, and guess what? You're only down 30% from the high. And you're excited. You continue to put more money in your 401k or your investment plan. And 6 months down the road, a year down the road, 1931, you look at your portfolio, you finally open that statement up and you say, what? I'm down 50%. How can that be? I put more money in it every month. Well, that's the way the market works. The market works in cycles. There's bear markets and there's bull markets. 1930 started a bear market, and that was known as the Great Depression. Another year down the road, 31, the values dropped even further. At the end of 1931, your portfolio's down $72 from $380. Now you're like, well, it's too low to sell, I just ride it out. That's what most people did in this bear market correction of down 55%. I'll just ride it out, and then the market slowly moves up a little bit higher, and then people start putting more money in it. Next thing you know, the market continues to go lower. The Federal Reserve during this time cut interest rates 8 times, freed up a lot of liquidity. What did they do? They caused the Great Depression. Because interest rates were low, nobody could make a profit. Then FDR put wage and price increases and control of the economy. Sort of like this current president. So then in 1932, at the low, we're down at $40 a share. You begin to wonder, hey, this stock market thing is nothing but a gamble. I can't sell now, I'll just lose too much. So you continue to hold long. You know, you started in 1924, you still got 5 more years to retire. So let's fast forward here to 1938. 1937, the market's come back. Ooh, you're feeling good. From 1932 to 1937 was a bull market inside a bear market. You're feeling good, it's coming back. Sort of like betting on the horses, right? Let's fast forward to 1942. 1942, you're ready to retire. Your value of your portfolio is at $94. You're still down from $380. What do you do? Well, your broker says, hey, you just start taking some income. Trade your stocks in. Okay. Stay tuned for part 2.